Ladies and gentlemen, welcome to our opening panel discussion on navigating fund distribution in Asia. We will look at the opportunities for international fund managers through four different lenses. Firstly, examining business models and regulations. Secondly, assessing new versus traditional players in the industry. Thirdly, regional perspectives and sensitivities. And lastly, digital transformation against the backdrop of the COVID-induced crisis. We are privileged to have representatives of some of the main brands with a track record in Asia Pacific to help us discuss these topics. Firstly, let me introduce Eric Bruce, Client Director for APAC and China of Aberdeen Standard Investments. Eric is vastly experienced in both designing products and distributing them in Asia, where he's worked for many years, and other international markets also, having spent much of his career at Standard Life and AXA Equity and Law before that. Welcome, Eric.
Morning.
Stewart Aldcroft, Senior Advisor and Managing Director of Citi Markets and Securities Services. Stewart works with many institutional clients across the Asia Pacific region, where he has been living and working since 1985, with high-profile roles previously at firms including Schroders, HSBC, Franklin Templeton, and Investec. Hello, Stewart. It's been too long.
It's been too long, Yuri. Good to see you.
Good to see you, Stewart.
We're glad to see we've both got grey hair, though.
Hopefully, we've still got a bit of it left.
A little
bit. And Amy Cho, Chief Executive Officer of for Hong Kong and Head of Intermediary Business for Asia Pacific at Schroders. Amy is responsible for all Schroders intermediary business across the Asia Pacific region, in which she has more than 25 years of experience, including senior roles at Pictet, First State, HSBC and Citi. Hello once more, Amy.
Hey, morning, good afternoon, everyone. Nice to meet you, Yuri, and everyone here. Thank you for the introduction, Yuri.
You're very welcome, Amy. And last but not least, Vivek Kudva, Head of APAC Distribution at Franklin Templeton. Vivek was recently appointed to this overarching regional distribution role in 2020, after having a key say in global distribution and also having previously ran the Indian operation during this 11-year spell with the funds firm, following on from 18 years at HSBC, where he was head of personal financial services. Great to see you, Vivek.
Hi, everyone, and thank you very much for the introduction, Yuri. It's a pleasure being on the panel. Thank you.
You are very welcome, Vivek. Great that you can join us today. If we start with business models and regulation, and if I can start with Eric Bruce at Aberdeen, the Asia Pacific region has been a particular arena for success for your firm for the last 25 years. Do you feel that Asian investors still buy very much into this star fund management culture? We know that Franklin Templeton for many years bombarded the media with adverts featuring the iconic Mark Mobius. Much of your offer is still associated with the magic, if I can say, sort of Hugh Young. And the Chinese mainlanders, they seem to be big fans of the celebrity managers, the likes of Feng Bo, with the new E-fund equity strategy, Zhang Kun as well. We've seen the likes of Kai Song of Lion Fund Management. You know, these guys, they can have 20, 30 billion dollars worth going into a fund launch. They've got their own fan clubs on social media. Is it time to move onto a more collaborative approach, away from this dangerous short-term personality cult-led investment trend?
Yeah, thank you very much, Yuri, and thank you also for the introduction earlier on. Listen, I think there's a number of great topics that we could pick up today, and this is a real good starter. Asset management requires long-term AUM, hot money. There's always going to be an attraction for some star managers. But hot money, as we know, can leave very much as quickly as it can arrive. In performance, investors lose faith, and there can, of course, be serious blow-ups as well. So, star managers, yes. I do believe that there's three reasons why things have moved on marginally. One is because of the hot money issue. It can leave very quickly, and you've alluded to that. The second one is due diligence. Large investors and their due diligence process looks at the team approach. They look to mitigate the risks of key persons and one individual leading things. Regulation is very much in tune with that due diligence process as well. So, yes, there could be hot money, but it's all about the processes. There's more and more. Every year, there's a greater emphasis on the processes. There's a greater emphasis on the team-based approach. We're seeing that, the trends that are there in terms of partnerships. So we at ASI, we've got a BRI partnership with China Construction Bank International, for example. That's a team-based approach. ESG has been really important to Aberdeen for many years now. We've got 30 years experience, and that can't be done by one individual. It has to be a team-based approach. Again, coming back into the due diligence. So if you're going to look at an ESG, a long-term, sustainable, robust process, then ESG and a team-based approach is the only way, really, that you can do that. And then it moves away. You've got some great managers. Of course, we, like many in the panel here, have got fantastic managers. It's all about the team that support the managers and give that longevity and reassurance and protection for the investors. Does that answer your question, Yuri?
That's a very interesting answer. That you've made some very good points there, Eric, about the collaborative, the team-based approach to hot money. And I'd like to bring in Stewart Aldcroft, because Stewart, you're a veteran of the Asian investment world, formerly with HSBC and Franklin Templeton, and much of your work was around marketing very much a star manager, the emerging market investing legend, Dr. Mark Mobius, who we mentioned earlier. I'd like to ask you, Stewart, in the Asia Pacific region, do you see access to the Chinese retail and institutional investors who are attracted to these star managers? Is access to those investors the main prize for international fund managers, bearing in mind that market access can be so restricted?
Thank you, Yuri. Yes, it's a good question, and it's something that all global fund managers who want to be in the region must answer. Yes, undoubtedly, getting access to China, getting it to either to the retail market or to the institutional market, or both, is the star prize. When you think about the size of the market, it is enormous, absolutely enormous. There's nowhere in the world that is growing quite as fast as China. And as you alluded to in the introduction, we are seeing blockbuster fund launches. There was a new fund launch in January by one fund firm. They raised $37 billion for the fund launch in one day. Nowhere in the world will you see that happening. And yet they put a cap on the subscription of just $2 billion. So they had to give back $35 billion. I can't think of a fund manager anywhere in the world that would give back that amount of money. But that's the way it's working right now. Now, if I cover a little bit of what Eric was talking about earlier. In the time I've been in Asia, 36 years, what I've seen is that fund marketing generally has got a lot more professional. It's very different. What we're seeing is a move away from what was at one time money off the page adverts. Do you remember those? No longer do fund companies promote themselves directly. More than 80% of all fund sales in the mutual fund retail market area is going via banks, and banks then are selling probably more than 80% of the products they're selling are UCITS products from Luxembourg or Dublin. So this is the connection that probably works very well for this purpose. All the banks that sell funds have fund selection teams. They don't necessarily look towards the star fund manager any longer. Typically, what they will do is to ensure that any fund that is selected onto their platform has achieved consistent growth and return over an extended period of time. But this is where China is different. China has built up the star manager culture. In terms of its marketing approach, I put it about 15 years behind where we are in the rest of Asia, but it's not necessarily going to catch up. It may change, but it'll change differently. The star fund manager has built fame by running a number of funds and then doing daily or weekly head and shoulders videos that are live streamed across bank platforms and other outlets. There are fan clubs for some of these famous names. I mean, it's unbelievable the star culture that has been created. So, things are changing there. But at the moment, and we'll come to the point that you're really asking, should global fund managers be interested? Absolutely. But at the moment, only 5 global fund managers have made an application to try even to participate in the retail market. Another 32 have made an application and have licenses now for what is known as the wholly foreign-owned enterprise group of foreign companies. But that is still a very slow progress by the rest of the world, if you like, to get into China. And then when you look at it from the institutional perspective, and I've talked about retail, but institutional, at the moment, there's probably between $4 and $5 trillion of assets allocated out as institutional money, and somewhere over 400 mandates. About half of that comes from China. And so clearly the region has a massive amount of money, and that's why we're here. That's why we want to be here.
Thank you very much, Stewart, for that overview. And Stewart talked about the distribution of UCITS funds and Luxembourg funds in particular by the banks. And Amy Cho, I'd like to bring you in. There was much talk for 15 years or so about a pan-Asian fund passport to help facilitate distribution in this region. Currently, there appear to be 3 rival schemes with the same objective of cross-border passporting. Will this plan become a reality, or is the Luxembourg UCITS brand more acceptable cross-border in Asia than any locally built fund structures?
Thanks, Yuri, for raising this very interesting, I would say challenging question. You mentioned the 3 rival schemes. Maybe I think it's useful for me just to remind everybody here which are the 3 rival schemes, which are all meant for the same objective about passporting. We have the Hong Kong China Mutual Recognition of Funds Scheme, and then we have the ASEAN Collective Investment Scheme Framework, respectively Malaysia, Thailand, and Singapore. And of course, we also have the APAC, the Asian Region Funds Passport Scheme, which have 5 locations included, like Australia, New Zealand, Thailand, Korea, and Japan. And I think the very unique thing is here within the APAC region, we have 3 passports discussions. While I think you mentioned about UCITS or in Luxembourg, in Europe there's only 1 passport. So I think this is the variance which might explain some of the experienced over the last like 10, 15 years about promoting or applying this passporting scheme. Going back to why we need a passporting scheme is I think we look at the investor needs, and given the market development in all these years over the last decade, what we have found is there's actually the growth in the investor demand for more global and also diversified strategies outside their hometown, their home jurisdiction. And one thing to note is Asia, amongst the various locations, for global managers like Schroders, and also I guess my colleague here like Aberdeen and also Templeton, is our strategies, global strategies, are largely housed on the Luxembourg users platform. And the reason not because we favor particular jurisdiction, but because that this is the passporting scheme allow us for the product on strategies to reach out to a broader and global clientele. So the design of which is actually very cost efficient to some extent. But going back to the investors, how the distributors actually pick the funds to be introduced to the end investors, they primarily still look after very much is about the return, the risk return profile of these strategies. And then more as a secondary considerations about the fund structure of the domicile of the vehicles, be they Hong Kong, Singapore, or any of these under the passporting scheme. And one thing also to note is within the region, I've mentioned 3 schemes and then 9 locations or 9 markets, some of which are already very established or major markets for UCITS. For example, Hong Kong and Singapore, Stewart and also those do very well. Then the other markets like Malaysia, Korea, New Zealand, Australia, they tend to be more domestic. And interesting, Thailand, they are also domestic, but during the recent years, the regulations has also been developed that to open up for UCITS. So on the one hand, we have the passporting. The objective is to enable the domestic or the local investors in this jurisdiction to have access to a broader suite of global diversified strategies to give them an alternative. On the other hand, actually passporting is not the only option for investors when they want to pursue, I guess, investments outside their home turf. So one thing to know, for example, one of the schemes which involve Malaysia, I think you know that Malaysia, a lot of times given the local investor needs, it's not just about global strategy. They also want to tell about Sharia. So we are seeing more Sharia strategies in particularly in addressing the needs of the Malaysian investors. Then one thing we need to be practical is, are these Sharia compliant Sharia strategies applicable or of equal appeal to investors outside Malaysia? I think so. Then it's not just about the product structure. It's also about the suitability of the risk profile of these investments. And also I think for global managers, besides leveraging on the Luxembourg platform of funds, or to do onshore domestic funds and then to gain access to different jurisdictions through passporting. There's also other means is actually fostering partnership with local players. Again, for example, Malaysia or Thailand, sub-advisory is very popular for the foreign managers to work closely with the local asset managers in terms of doing localization of international strategies, which are the expertise of these foreign managers. So I think back to your question, Yuri, is it's not to say that it's not a competition between the passporting and the Luxembourg users platform. I think how the funds on these platforms will be able to complement and supplement each other in addressing the broader investment needs in terms of the risk return profile of the investors within the region of APAC. And I think the structuring of which is just, I guess, is a secondary consideration which some of the distributor may consider, but not the main buying factor or consideration.
So thank you very much, Amy. All 3 speakers so far have talked about the products as well as the markets opening up. And I'd like to bring in Vivek Kudva. There have been times, Vivek, alluded to by Stewart earlier, when China has liberalized the regulations for Western fund managers to distribute products on the mainland, and other times when the authorities have been slightly more restrictive. Where are we today in this cycle?
Well, I think that more recently there have been several regulations that actually enable global managers to participate more in the China market. So the way I tend to look at it is that you look at the business, the China business, as in three buckets. The prize, of course, is the domestic fund management company. So that's the big prize. That is managing money in China for Chinese investors and broadly investing in fixed income and equity markets of China. Now, there are multiple routes to get there. You can now have 100% ownership of a JV. So that's one option. Two, you can have a PFM WFI, as Stewart mentioned, and you can use that route to actually apply for a fund management company license. Or there is a third one now, which is really global managers can take a majority stake in the joint ventures with the wealth management arms of the banks to set up an asset management company. So that's one pool. So I think, everything now is available. Then the second bucket I look at is really the money that is going outside China, that is the outbound money. And you can look at that as the QDII, the QDLP, and the institutions allocating to offshore, mandates. So that's the second piece. And I think there also, there's the regulations are being liberalized. And the third really is the inbound business, right, which was the QFII business. And even there have been some changes now. The quotas have gone, you just need to register and then you can access that. And that's a big opportunity because global institutions and retail investors are underweight China. So there is going to be inbound, flows coming in. And that's a big opportunity to capture. So when you look at all of this, I think the strategy, and there's a rush, it's the fear of missing out in China, and there's a rush, as Stewart mentioned. I'm told that there are over 100 licenses, that have applications that have come in for a fund management company, and not all of them are going to get it. So I think I think everybody's strategy in China can be described by one word, and that is optionality. Do different things so that you have an option to actually play big in China. And so if you look at Franklin Templeton, we have a WFI and we have joint venture for last 15 years in China. And that's the optionality that we took several years ago. Now, there's a saying in China that is, I think, attributed to Deng Xiaoping, which is basically saying that cross the river, one by stepping on the stones, which is really that you be careful, don't go and do large amounts of regulatory changes. Do it one step at a time. Understand that how it impacts the market, how it impacts end investors, the retail investors, and then do that. But I think that process has started, and it's moving in that direction. So from our perspective, I think China is opening up, and it's all about optionality. It's a fear of missing out, and for those who are successful, I think the prize is massive, because I think the Chinese market will be bigger than most of the markets globally, and China is going to become the largest economy in 2 decades. So it's a big prize.
Thank you very much, Vivek, for laying down all those trends, and you mentioned the regulatory side, and I'd like to bring in Eric Bruce once more from Aberdeen. Eric, what sort of influence do you think trends coming from mainland China will have over financial services in the broader region? Bearing in mind, Chinese officials don't seem to like money being drained from Chinese banks and going to other types of maybe non-traditional players. Will we always see political pressure in favor of the banks against the tech entrepreneurs and maybe the celebrity managers and other asset managers? Will there always be a regulatory bias in favor of banks?
Yeah, thank you, Yuri. So listen, I think there's a number of parts that we've heard from Vivek and Amy there, as well as Stuart, in terms of some of the things that are happening. I would agree with some of the trends of money going in to China, China A share, China bonds, PRI, I mentioned earlier on. So the money going in as well as the money that's out of the market. COVID, the COVID recovery is a huge theme, and that's going to dominate not just China but also the region and the investment there. China's stated income is carbon neutral. Seems to form a big driver for increased ESG. I mentioned ESG earlier on. So these things are there. The growth of the middle classes, the wealth. We've heard some great points about the growth of China being the big prize. Fear of missing out.
Can I, Eric, can I interrupt you? We're having trouble hearing you. Can you move slightly closer to your laptop, please?
Yeah, sure. Oh, sorry. Can you hear me better now?
When you look up, we can hear you. When you look down,
Okay.
not so well.
Oh, okay. I'm very sorry. So I was just highlighting that there's a number of things that are happening in the marketplace. The COVID recovery is a big driver. China's stated aim to be carbon neutral by 2060 is a big theme, and that will drive. That's going to drive regional and indeed global. The appetite for investors into China, I was mentioning there, in terms of China A share, China bond, BRI fund, people on this panel will recognise all of that as well. These are massive drivers for what is happening not just in China, but in the region, and as I say, the options that are there. The opening up of the markets, as Vivek is pointed out as well, are key, and that leads Yuri to the second point, I think, of your question here. China leads the way in terms of e-commerce and Chinese banks and fintech. So China is already leading the way. The fintechs have an advantage. They don't have the legacy of the banks. But then you've got the regulators, and regulators do like regulated entities. Banks have invested heavily in e-commerce as well, of course. So I think there's always going to be some tension there. But the banks have invested heavily and will continue to invest heavily so that they can engage with their clients. Will be the winners. So the fintech, the entrepreneurs, they don't have that baggage, but there's increased regulation. They've got to protect clients. So the banks that can learn and incorporate that technology will be the ones that will do best. And I'll talk about that later on as well.
Thank you very much, Eric. And I'd like to build on some of those points in a question to Amy. There's been a strong challenge, Amy, in this region from the non-financial players setting up fund products. And, we've seen Jack Ma's Ant Group, for instance, has been very much in the news with its huge money market fund. Do you feel the big techs will inevitably become more deeply implanted in the fund distribution ecosystem?
Hey, Yuri, the challenge in this region is always around, not only solely from the non-financial players that we face, but I think going back to your question is, yes, we've seen how the non-financial players, like the name that you just mentioned, they have success with the money market fund. But do bear in mind, money market fund actually is a cash management proposition. It's not necessarily, I guess, holistically the wealth management proposition, but part of it. And remember that our conventional fund distribution model also carry money market funds, but then more consciously as a parking vehicle for investors between when they are decided about which funds to invest. And if we look more broadly in the wealth management space, I would say that disruption is there, but it's not only from the non-financial players, but also with the emergence of virtual digital banking licensee, as what we have found in the markets like Hong Kong and also more recently in Singapore. And these unlike the non-financial players, the digital bank licensee, because they have a banking license, and they are putting also ambitiously, they will definitely enter into the wealth management market and then challenge the incumbent bank's distribution model. But when we look at the things is, okay, you ask about whether the big techs then will they inevitably become more deeply implanted in the distribution ecosystem? Yes and no. I think like digitalization, big data is the big trend. And as this development continues, and also I guess seeing the eventual growth of e-wallets, open banking, data aggregation, I think the industry's distribution dynamics will change. And also at the same time, because our clients' expectation and also buying behavior will change. In addition to looking at fund performances or star managers, they're also looking more for about the client, the total experience. So I think the challenge is, I think, or actually, it's not only the that will become more deeply implanted. I think generally, I think asset managers also have a role to play. Is we evolve our role not only as a product provider to these, I guess, fund distribution ecosystem, but to transform our business model to become more embedded with the distribution ecosystem, be they with the financial players or the non-financial players. And the target or the focus would be about offering like the wealth management solutions, have a digital tools, and all these ecosystem together will bring along a more pleasant and holistic experience to the end investors and millennials and the new generations.
So thank you very much, Amy. If I can bring in Vivek at Franklin Templeton. Amy's talking about a change in the distribution dynamic. She also mentioned the non-financial players and the digital and virtual banks, which are taking an increasing piece of the cake. And I'd like to ask you, which will be the key financial services trend going forward? Will it be the likes of TikTok we've seen, the non-financial player, bidding for banking licenses in Singapore, linking up with family offices, or perhaps your own example of Franklin Templeton, a very much an established financial services player, teaming up with a new tech startup such as Bamboo to distribute funds to a broader market?
Yes, so very good questions, Yuri. So let me explain how kind of we look at it. So really, the starting point is that you have young investors in Asia. They're digitally savvy, and they're not going to invest the same way that we invested or our parents invested. They are going to look for a much better user experience when investing, and they're very, very comfortable using their mobile for most of their transactions. So that's the reality, right? So when we look at this opportunity, the way we've approached it is that there's a three-pronged approach. First is we invest in fintechs such as Bamboo and Quantifeet, which are digital wealth platform providers, and more recently in a firm called Coherent, which is an insurance technology provider. So these providers, these platform providers actually can provide the platform for clients who wish to go digital. The second is the tie-up with actually some of the, some clients, for example, like Razor FinTech and Phenomena. So these are firms that have a large client base, and they're looking to actually get into wealth management or provide investment solutions to their clients in multiple jurisdictions in Asia. So what is the role then for the investment management company like ourselves? So we invest in these fintech companies, we do the tie-ups with these other firms, right? And our aim is to become the investment solutions provider on these platforms. So we then introduce, say, a Bamboo or a Quantifeet or a Coherent to the clients, depending on what they're looking to do. We then provide the investment solutions, which typically is open architecture, right? And we've got a couple of proprietary tools, which is called a goals optimization engine and a dynamic retirement investment vehicle. We then use that to actually customize, automated customization at scale. And you're able to do that because of technology. So literally, if you are a client, you can get a one-to-one solution for your investments, which was hitherto not possible because the technology didn't exist. So that's how we look at it. And I think that there are going to be many such tie-ups. But for us, we are not straying away from our core expertise, which is providing the investment solutions. What we are doing, we're actually, by getting the fintechs, we are providing a service to the clients we tie up with, because we provide them the platform, and the platform is then white labeled for them and tailored for them. And they have an up and running, state of the art, high user experience kind of platform that they can take to market immediately. So that's really a strategy. Having said that, I think the existing distribution model is not going away. It will coexist with these digital models, except that the digital ecosystem is going to continue to grow because the world is moving digital. And as we've seen it in the pandemic, what has really happened is firms that had a digital proposition have all thrived and grown at the cost of others. So we see this as the way forward.
Thank you very much, Vivek. We've all laid down the descriptions of some interesting competing models, and I'd like to bring in Stewart Aldcroft, because we've got three of the biggest regional fund groups next to you today: Schroders, Franklin Templeton, and Aberdeen. And as a fund servicing expert, you work with all the biggest brands. I remember you once gave me a lecture in your Hong Kong office about the 4Ps formula for successful fund distribution. I think it was product, price, performance, and people. How do the Chinese fund groups and the Asian regional and the international names you deal with measure up to this blueprint for success? Because after all, we see some global names now struggling to recruit staff, with the Chinese managers for the first time, the local managers seen as the preferred destination for investment and sales staff. So which models are the most attractive at the moment?
Yuri, what you're talking about, of course, is bank distribution. And typically the bank distribution platform that we operate in Hong Kong through Citibank, and it's very much the same at most of the other banks, HSBC, UBS, DBS, etc. The key here is, if you want to put your funds onto a bank platform, it has become really quite difficult. The reason being there are too many fund choices, and there are too many people who are not doing well enough. Very briefly, I'll describe how we put funds onto a platform, and then you'll see how it works for the Chinese managers as well. I mean, typically we'd have about 100, 120 funds on our active list. We look at it every month, and then from the active list, we probably distill that down to 30 or 40 for the focus list. And those are the funds that we would aim to try to sell across the region. So where we have outlets in Hong Kong, Singapore, Taiwan, Malaysia, Thailand, if they can use the same fund, that's ideal. We are even using exactly the same funds in China under our QDII quota. So it's a very broad spectrum. However, to get onto that list, as I said earlier, a fund needs to be in the top decile of performance and needs to consistently achieve that over at least 3 years, possibly longer. We are very open as to whether or not we use UCITS or other products, but for the most part, we will use UCITS simply because they have the scale. Because ultimately, any fund that gets onto our platform, we would normally expect to raise a fairly high number of hundreds of millions of dollars, and therefore needs to be a decent sized fund, more than $1 billion in size. Now, when it comes to Chinese managers, we have exactly the same situation, where it's outside China. In other words, if their fund is authorized in Hong Kong, if it's in Singapore or wherever, then the same process exists. But most of the mainland fund managers have not necessarily got very large mutual funds out, and of course they are only known for their ability to manage Chinese securities, whereas global fund managers can manage most different types: bonds, equities, and in different target markets. So that's the broadness of it. Of course, will Chinese managers develop? Yes, they will eventually. I suspect that in the next 5 years, we'll start to see a number of these big Chinese managers starting to buy some of the Western managers to build their global expertise. And that, I think, is a big development for the future.
Thank you very much, Stewart, for outlining those major trends, both global and regional. And we've got a lot of questions coming in from the audience. So I'd like to share some of these with our panel. If I can put the first one to Vivek, how has if we look at what Asia has learned from previous crises before COVID, if we look at the SARS crisis, if we look at the global financial crisis, and crises before that, 1987 as well, what has Asia learnt from these events, and how has the fund management industry adapted to these crises in terms of changing its distribution model?
So I think that's an interesting question, and there's no one answer to it.
Sorry, and obviously we're including the latest, the response to the COVID crisis as well.
Yeah, so I think the fund industry overnight has had to move from a model where the distribution model was really about meeting folks and engaging with clients. You had to move to a completely virtual kind of environment. I think going forward, the big learning from this will be that yes, what were the benefits of actually working virtually, and how much of that will be the model going forward. It's going to be a mixed model in my view. So there's going to be the part that is going to be different digitally, virtually, and then there's the piece that you still have to go and meet clients, especially if you're trying to meet new clients. If you're trying to engage with new clients, I think it's easier if the first meeting is done in person. So I think now the investment management industry has become much more resilient. There have been several crises we've seen, and it's become much more resilient. And when I look at Asia is going to be a growth market, notwithstanding all these crises that come and go. Asia is going to be a big driver of growth globally. And therefore, if you're in Asian markets, you will continue to find opportunities, notwithstanding you have these crises. When you have these crises, obviously, you have a big impact. AUM falls, people pull out money, there's all this kind of stuff that happens, right? But in the long term, I think these markets are going to grow. And the biggest growth is going to come from these markets. And that in itself is the opportunity. So I think we are all resilient. We are all positioned for that growth.
Okay, so we're positioning ourselves for this growth. We've got another question about the dynamics of this growth, and I'd like to bring in Eric Bruce. The questioner says that 10 years ago, Asia Pacific accounted for about 10% of global AUM in asset management, with a highly fragmented marketplace. Has very much changed since then? Are we still talking about those kind of numbers, or are we talking about much higher numbers in percentage of AUM? And what's really changing in the dynamics of the makeup of the AUM and where they're coming from? Hello, Eric, can you hear me?
Yeah, I can. Can you repeat the question, Yuri? Sorry, it broke up a bit there. I didn't hear the question. I beg your pardon.
Our questioner was asking about the dynamics of the growth. 10% of AUM it was in Asia 10 years ago. How's that changing now, and where's the growth coming from?
Listen, the growth in Asia is just off the charts. Really, if you look at China, the wall of money that's coming from China, we are seeing Our China A share fund is now through $6 billion US. We're seeing others that have got more than that. So the growth in Asia, that's where the focus is on. It's where our focus is. Our new chief executive has stated our growth strategy is firmly in Asia, and other groups will be in exactly the same position. The growth is only ever going to continue, especially when you've got what we've seen, the recovery in China over the past year. The GDP growth there has been remarkable over the past 12 months, where many other countries have struggled, quite frankly.
Thank you very much, Eric. And I'd like to bring in Amy about specific distribution opportunities. There's a question from a private banker here in Asia, and they're asking, the Greater Bay Area, is there a distribution opportunity for that area in this strategy that's very much being laid down by the authorities in China and seems to be followed by the funds industry as well?
Okay. Yes, I think my short answer to your to private banker, yes, it is. I think for China, we need ambition, we need commission, and at the same time, we need patience. Of the Greater Bay Area of mainland China definitely provides an opportunity for fund managers to access to the GBA investors through the banks in Hong Kong. As I've said, Hong Kong is already a fairly established funds market for both onshore and offshore funds. And this GBA Wealth Management Connect initiative is just, I guess, open another door to accessing a broader clientele and through the bank system, the ecosystem in Hong Kong. Worth to note, Hong Kong, actually, we enjoy the proximity to mainland China. So to a very large extent, I think the investors in the mainland Chinese investors, they look to Hong Kong for guidance on where to invest their money outside mainland China. And I think in terms of population, GBA, it is at the 10 times Hong Kong's population, as a GDP of $1.6 trillion across that GBA region, which exceeds that of California. So it's actually one of the top 12 economies in the world. I think these numbers really, I guess, very, very alarming at the same time, create a lot of excitement among the investors. But I think if for the audience to raise the question, the private bank, unfortunately, in the phase one of this GBA Wealth Management Connect scheme, is only the retail banks in Hong Kong will become eligible. And to some extent, is there also, I guess, a suite of wealth management products that will become eligible for marketing for the banks in Hong Kong to induce the GBA investors. But the good thing, or actually, I would say the Wealth Connect is more innovative than the current scheme. We know in China we have the QDII, we have the MRF. So I think one key attraction we found is for the more recent and compared to MRF is there's no restrictions, and in a way there's no product approval requirement, no additional license requirement, as long as the fund is as authorized by the Hong Kong SFC, Hong Kong domiciled, and it could be eligible as a low to medium risk rated investment products that will become eligible. So I think this improved the flexibility of investors in mainland China to access to the wealth management services by the banks in Hong Kong, and in a way also promote the cross-border activities between the two locations within this GBA region. So I think, again, the short answer is yes, it's an exciting initiative.
Okay, thank you, Amy. We've got 30 seconds left, I'm afraid, so I'm just going to throw it over to Stewart. And we've got a few questions about the whole HK Stock Connect system from various viewers. And one of them is saying, well, it's a bit limited at the moment. Which other types of funds are going to be involved? Will ETFs be involved in the Connect system?
Stock Connect has been massively successful. As at the middle of January, end of January, more than $250 billion of transactions had occurred. By any stretch of the imagination, it has worked well for both sides. That is money coming from the rest of the world, investing into China A shares, and also from China, fund managers have been buying into Hong Kong stocks. At the moment, there is no current timeline for an ETF Connect equivalent, which is frustrating for everybody involved in the ETF business, but it has been something that has been talked about for 3 or 4 years, but various technical difficulties have blocked the passageway for that. So, but Stock Connect has been a wonderful development, and it demonstrates really when things go well in the linkage between Hong Kong and China, how important Hong Kong is, and how big the China market is.
So I think the message we're getting from a few of you is don't write off Hong Kong. A lot of people have said its future as a financial centre is in question, but the message very much from our panelists is there's certainly a lot more to come. So many thanks to all our panelists for a fascinating opening panel discussion. It has certainly given me plenty of food for thought, and I hope inspiration for our other participants during this very packed day, the next of which will be Hugo Bassi, one of Europe's leading regulators, who will share his vision of the future of cross-border financial services. He'll be grilled by an old friend of mine, Matthew Vincent, with whom I had the great pleasure to work with back in the 1980s on MoneyWise magazine, when I remember him writing about the UCITS directive, even then in its early days. After an eventful career, he had a stint during which he had a stint as a TV host and editor of the Investors Chronicle. He's now regulation correspondent at the FT. So I'm sure that will be an enjoyable session. So please, ladies and gentlemen, have a break, enjoy a revitalizing cup of tea or coffee, and we'll see you all in 10 minutes. And my thanks again to Stewart, to Amy, to Vivek, to Eric for sharing your thoughts and your visions with us. Thank you very much.
Thank you very much.
Thank you. Thanks, Yuri. Thank you, everyone.
Thank you.